Hello all, welcome to the Unit 2 assignment unpacking video. In this video, we're going to be going over the scenario and just how to note what you would need in order for you to calculate an NPV calculation. Without further ado, let's go. So my scenario notes this time are as follows. So Alpha Mega, a toy manufacturing company in South Africa, has been developing a new product. So you know that there is a new product that has been developed at a total cost of 1 million. So they've been developing this product and it costed them 1 million to develop that product, right? For the past year, and the company is now ready to begin full-scale production in January 2027, right? So then in your mind, you should then know that this 1 million becomes a sunk cost, or a cost that won't be included in our NPV, because our production is about producing the product that has already been developed at this cost, right? So then we know that 2027 is when our project is actually starting. That's where our timeline is at. Then new products will be manufactured using several machines, which will need to be purchased at a cost of 5 million. Okay, so now everything here is speaking towards our project that is starting in 2027, right? This cost will be incurred at the beginning of the year, and the machines will be installed in time to commence production in the new year. Okay, so when they say production in the new year, we can then assume that this 500 is being purchased in 2026, right? Before the actual realizations of the cash flows is shown by starting the production in 2027, but we still had to go buy those machines in order for them to start the product, and those machines were bought in the year 2026. So this becomes a relevant cost because it's a cost that needs to start the project, right? So this cost will be incurred in the beginning of the year, and the machines will be installed in time to commence production in the new year. Production will commence during January 2027. So we were right to assume that this 5 million has been purchased in 2026, right? And should be included in our NPV calculation. Production will commence during the output volumes will generally increase as the employers become more skilled at operating the machines, right? So you can expect growth in the number of products that have been produced. Yes. So Alpha Mega prepares its annual accounts on the 31st of December each year. So more scenario notes. This is just additional information that will teach us how to actually go about and count. So the previous slides, we saw numbers that we knew that we needed to use, and also we were able to establish a timeline to say that, okay, our project starts, the actual work starts in 2027, but there are costs that we incurred for the for the production to take place, but that was incurred in 2026. So meaning our timeline is 2026 up until 2031, right? And I'll explain how we get to 2031. So then this is the products are to be manufactured. Apologies. The products are to be manufactured in units, and the cost of each unit is expected to be as follows. Direct labor, 20 Rand. Direct material, 15 Rand. Variable overhead, 15 Rand. But then they tell us that these costs relate to prices in 2026, right? So meaning that we might be expecting some sort of growth, because time value of money tells us that the value of money decreases over time, right? So because of certain influences, right? So then we need to then look at what they are telling us down here, where they say production costs are not expected to change because of the investment in the new machinery, but direct labor and direct material inflation is expected to be at 10%. So now we are told that here we need to grow our direct labor value by 10%, as well as our direct material at 10%, and only our variable overhead is going to be grown at 7%, right? So we have those tools now. So scenario notes, again, we're not done. Every single piece of the information that was granted to you is of use. So you just need to figure out how to use it, right? The product is expected to incur a fixed cost of 1 million, right? So then we know that there is a 1 million fixed cost, and it is only incurred in the first year, right? So it's incurred in the first year as 1 million, and inflation is expected to be 6% per year. So meaning this 1 million is going into our timeline from year one all up until year 2027, all the way up until year 2031. No, 2030. Right. These include some specific non-production costs, but does not include the depreciation of machines. Okay, got it. Production of sales. The company does not plan to start selling the product until October 2027. Right. So within those months prior, they are sourcing the material, obviously. They are working the machines, and there may be a bunch of trial and error that they need to do. So as just a caution, they decided to map it out up until October 2027, right? This will allow time to build up sufficient inventory as well. So if they get the trial and error correct, and now they've got a lot of inventory of the product to enable the company to meet demand. So should there be a big demand for all the products, then they know that they have done enough or produced enough products, right, by October 2027. So even in October 27, we will be seeing sales, right? We will be seeing sales, and we will be seeing profits. Right? So you can understand that within our timeline, sales in 2027 will be part of our calculation for the cash flows that will need to be discounted. For accounting and taxation purposes, each unit of inventory is valued at 10 Rand, right? The company has produced the following schedule of production and sales volume for each of the 3 years. So now we've got this going on. Right, so now we've got this going on where they tell you that the production units are 50 and the rest, and then the sales units are this moving forward, right? So let's see what we have to do with those numbers. Okay. Lastly, we've got additional notes again. These notes are there to like just show you which numbers are important and how you're going to be using them forward. So that's why I keep coming back to these and ensuring that you guys are highlighting what is important based on your understanding of this theory, right? So the initial selling price of the product will be 200 per unit in 2027, right? As the production becomes well known and in order to execute competitors off the market, the price will reduce and at the start of 2028 to 100 Rand. So you know now that your sales volume multiplies by your sales price gives you your sales, right? So we know that for the first year, whatever sales volume we have, we are going to be multiplying it by 200. But as time goes into 2028, we are going to take whatever volume that we have created and multiply it by 100 Rand, which is the new price that we have gotten, right? So price per unit to get our sales. It is expected that the company can continue to charge this price for the remaining life of the product. So you know that this price will stay the same all the way up until the end of the project, right? Capital costs. The machines will be used solely for the new product and will be purchased on 1 January 2027 at a cost of 5 million, right? And an expected residual value of 700,000 at the end of 2031, right? Tax depreciation at the rate of 20 per annum on a reducing balance basis. So we know that we're going to have to be reducing this amount of the machines by 20 in order for us to get our depreciation. And also we need to get the tax benefits using these amounts, right? As well as this amount that would be then a profit to us when we eventually sell it off, right? Taxation. Alpha Mega is liable to pay corporate tax at the rate of 27% for its profits. So we know that once we are done calculating sales and all the operation costs and whatever, you will get your profit. Your profit then will be taxed, right? One half of its tax is payable in the year in which profit is earned, and the remainder is payable in the following year. So now we know that we're going to take our tax amounts and divide it by 2 for year 1. But in year 2, you have then the half from year 1 plus the half of year 2, and then year 2's it's going over to the third year, right? Inflation. It is believed that the effects of inflation on investment are insignificant and can be ignored. So the inflation that they're talking about here that you can ignore is the inflation on your sales and profits, your sales specifically, right? So you can ignore that. But the inflation that you had been introduced to in terms of the costs is what you have to use, right? Cost of capital, EPA uses a post-tax cost of capital of 14% to evaluate investments of this type. So we know that we're going to have to use this in order for us to get our NPV. This is going to be our discounting rate. Right. So let us look at the required, right? The required states that we need to calculate the NPV of the investment proposal and advise Then there's a second part where it says advise alpha mega whether or not the investment should proceed. So now in this advise, you are using your theory or understanding of what NPV is, right? Because with NPV, if a project is greater than 0, then it is positive, then it should be accepted. If the NPV is lower than 0, then it means it's a negative and it won't be accepted, right? So that would be the advice that you would give, is after you've done your calculation, is your NPV positive or is it negative? And as such, then you would tell them to say, hey, you can invest or not, right? We're going to be looking at the discounting formula when we are calculating this. We are also going to suggest, I will suggest that you can also use your financial calculator as well as Excel. So I will cut this video off over here before we get to the memo.